Thanks for joining us for a recap of what happened in the economy this week. It was a busy week and even busier with all the government shutdown talk. Let's dive in. Before we begin, remember to like this video and subscribe for more economic updates. Without question, the biggest news of the last several days concerned the Federal Open Market Committee's second policy meeting of 2024. As expected, committee members left the federal funds target rate unchanged at 5.25% to 5.5%. What Fed watchers have been less certain of is where monetary policy might go from here. Recent headline measures of the economy were stronger than expected, raising questions about whether central bank officials might revise plans to cut interest rates 3 times this year. In their updated summary of economic projections, committee members once again penciled in 3/4-point rate cuts by the end of 2024. At his post-meeting press conference, Jay Powell reiterated that it is the intention of policymakers to begin rate reductions this year, saying, "We believe that our policy rate is likely at its peak for this type of cycle, and that if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year." At this time, CME Group's FedWatch tool, which evaluates probabilities of changes to the Fed funds rate, is indicating a near 75% chance the central bank will start cutting rates at its June policy meeting. In other news this week, there were 3 updates on the health of the housing market, each of which suggested conditions there may be improving. On Monday, the National Association of Home Builders got the ball rolling with the release of its Housing Market Index for March. The index, which gauges sentiment among builders of single-family homes, rose 3 points to a measure of 51, making this the 4th consecutive month the index has gained ground. This also marks the first month since last July the index has come in above 50, which indicates a positive builder outlook on home sales. Next, the Census Bureau revealed on Tuesday that housing starts in February saw their biggest gain in 9 months. According to the data, residential housing starts jumped 10.7% in February to an annualized rate of 1.52 million units. That's 80,000 more than economists were expecting. Sales of existing homes rose 9.5% month over month in February to a seasonally adjusted annual rate of 4.38 million. Elsewhere this week, S&P Global reported that its Flash Manufacturing Purchasing Managers Index climbed 0.3 points in March, coming in at 52.5. Analysts had projected it would drop by nearly 0.5 point this month. Not only is it the 3rd straight month the index has strengthened, but the metric now sits at a 21-month high. S&P also reported that its flash services PMI fell this month to 51.7 from 52.3 in February. Even with the decline, services PMI has remained above 50 and in expansion territory for the 14th straight month. Finally, in what may be one of the most surprising pieces of data to emerge this week, the Conference Board reported that its leading economic index actually increased last month for the first time in 2 years. The board, which recently dropped its long-standing recession forecast, said LEI crept up by 0.1 point last month. In a statement, board officials said that despite the rise in the index, the Conference Board expects annualized U.S. GDP growth to slow over the Q2 to Q3 2024 period, as rising consumer debt and elevated interest rates weigh on consumer spending. That's a lot to take in, so rest, have a good weekend, and join us on Monday when we'll get right back at it. This is Devlyn Steele for Augusta Precious Metals, signing out.